Welcome everyone. Thank you for being here today. I'm excited to introduce our presentation on the software STC market bull. Today, we'll be focusing on the concept of the fair value gap, or FVG, and explaining what it's all about. In this session, we'll cover the basics of FVG, why it's important, and how it can help you in your trading strategies. So, let's dive in and explore this fascinating topic together. Understanding price imbalances in trading is crucial for identifying where the market might be inefficient. One key concept here is the fair value gap, or FVG. An FVG happens when there's a noticeable price imbalance that results from aggressive order flow. Essentially, this means that certain trades were skipped over or missed by institutions, creating a gap in the price action. These gaps highlight areas where the market hasn't fully reflected all available information, which can present trading opportunities. So, when we see an FVG, we're looking at a potential sign of inefficiency, a spot where price might revisit to fill that gap. Recognizing these gaps helps us understand where the market might move next, aligning with our overall goal of trading smarter and more efficiently. The resultant imbalance zone from the FVG, or fair value gap, highlights areas where the price has moved very quickly. This rapid movement often signals a potential point where the price might return to rebalance and fill those orders that were left unfilled during the sharp move. Now, let's talk about how these imbalance zones are created. The key here is the middle candle in a formation. When this candle shows a notable expansion, meaning it has a much larger body compared to the candles around it, it reflects aggressive buying or selling pressure. This sudden surge in activity is what leads to the creation of an imbalance zone in the market. Focusing on the middle candle, its expansion is critical because it indicates strong order flow. When a candle expands significantly, it suggests that traders are pushing the price strongly in one direction, leaving behind a gap or imbalance in the process. This brings us to the three-candle structure used to establish the fair value gap. Essentially, the FVG is formed when the middle candle expands notably within a three-candle formation. This expansion signifies robust order flow, which creates a visible imbalance in the price structure. Understanding the formation of FVGs is crucial because it helps us identify potential areas where the market might revisit to fill these gaps. Recognizing these structures allows us to anticipate possible reversal points or areas of interest for trade setups. So, in summary, the creation of imbalance zones through these three-candle formations, especially when the middle candle expands strongly, provides valuable insight into market dynamics. It highlights where aggressive trading has left unfilled orders, setting the stage for potential rebalancing in the future. Let's take a closer look at these visual examples of both bullish and bearish fair value gaps. As you can see on the charts, these gaps appear during strong market movements and can serve as important areas of interest for traders. Recognizing these gaps helps us identify potential entry and exit points. A bearish fair value gap typically forms during a sharp downward move, and it often acts as a future resistance zone. Sellers can use this gap to their advantage, entering trades when the price retraces back into this area. On the flip side, a bullish fair value gap occurs during a strong upward impulse. This type of gap can signal a future support level, where buyers might step back into the market after a price retracement. Understanding these gaps, both bullish and bearish, is crucial because they highlight where the market might find support or resistance, guiding our trading decisions. So, in summary, these gaps are not just visual quirks. They're key indicators of potential market turning points, and recognizing them can greatly improve our ability to anticipate price movements. Let's dive into understanding institutional rebalancing inefficiencies. Often, institutions leave behind price imbalances, and this happens because of order fulfillment constraints. In simple terms, they can't always execute trades instantly or perfectly, which creates gaps or imbalances in the price. Now, these gaps are not just random. They actually present opportunities for traders. When prices revisit these zones, these imbalance areas, they tend to correct or rebalance, which can be a profitable moment for those paying close attention. This brings us to why fair value gaps matter so much. They highlight these zones of imbalance, and recognizing them allows us to anticipate potential price movements. It's all about understanding where the market might go next based on these inefficiencies. So, by studying these gaps and the institutional behaviors behind them, we can better position ourselves to capitalize on these corrections. This ties directly into our overall theme of market efficiency and finding opportunities within these imperfections. Let's dive into the concept of an order block. Think of it as the foundation for institutional orders. It represents those key consolidation areas where the market pauses before making a significant move. These zones highlight where strong buying or selling interest has taken place, giving us clues about potential future price actions. Now, moving on to the origin of these orders. They often stem from what we call a fair value gap, or FVG. An FVG is essentially a price inefficiency, an area where the market hasn't fully filled orders, leaving a gap. This gap indicates that market participants may look to rebalance these imbalances, which can create opportunities for us. Understanding these concepts, order blocks and FVGs, is crucial because they help us identify where the market might react strongly. While order blocks show us where big institutional activity has occurred, FVGs point to areas of potential imbalance that traders aim to exploit. So, when comparing FVGs and order blocks, think of them as interconnected tools. Order blocks are like the solid foundation built from institutional interest, while FVGs highlight the inefficiencies where price may quickly move to fill those gaps. Grasping these key concepts helps us see the bigger picture in trading, understanding where the market might pause, reverse, or accelerate based on these underlying dynamics. Let's take a closer look at FVGs, or fair value gaps, and their significance. When you spot FVGs within either premium or discount zones, it often signals a potential reversal point. These zones are particularly interesting because they tend to attract institutional interest, which can create ideal conditions for profitable trading opportunities. Now, a key concept here is the break of structure, or BOS. When the market breaks a previous structure, it confirms a shift in sentiment, either from bullish to bearish or vice versa. Identifying FVGs after a BOS can really improve your chances of making successful trades because it shows where the market might be poised to revert or continue. Another important aspect is liquidity sweeps. These happen when the price moves aggressively to take out resting orders. Think of them as the market's way of rebalancing. Liquidity sweeps often occur in high-probability zones for FVGs because the market is clearing out liquidity before making a move in the new direction. All of these concepts, FVGs in premium or discount zones, BOS, and liquidity sweeps, are key areas to focus on when developing effective trading strategies. Recognizing these zones and signals can significantly enhance your ability to identify high-probability FVG locations and improve your overall trading edge. When considering the ideal entry point for a trade, it's best to aim for the 50% level of the fair value gap, or FVG. This approach balances risk and reward effectively. By entering at this midpoint, you give yourself a better chance to manage potential losses while maximizing profit potential. Next, it's important to wait patiently for the price to retrace into the FVG zone after a significant move. This retracement creates an optimal entry point because the market is often more receptive to a reversal or continuation from this zone, increasing your chances of capturing profits. Before jumping into a trade, establishing a clear directional bias is crucial. This means understanding the overall market trend and ensuring your trade aligns with it. Doing so helps you stay on the right side of market momentum and significantly boosts the probability of success with your FVG trade. So, to recap, the key steps involve waiting for that retracement into the FVG zone, entering around the 50% level, and confirming your directional bias beforehand. Mastering these steps can really enhance your ability to navigate fair value gaps effectively and improve your overall trading results. Combining FVG analysis with liquidity levels really boosts our chances of success. It helps us make sure that our trades are aligned with institutional order flow and the overall market dynamics. When we understand where liquidity is concentrated, we can better anticipate where the smart money is moving. Using lower timeframes for entries is also a game changer. It allows us to execute trades more precisely, so we can take advantage of short-term movements within those FVG zones. This precision can make a big difference in our results. At the same time, analyzing higher timeframes gives us a clearer picture of the overall market context. It helps us see the bigger trend and identify potential reversals that are related to these FVG setups. Combining both perspectives, the micro and the macro, really enhances our trading techniques. This approach is all about refining our skills and making smarter, more informed decisions. When we integrate liquidity considerations with timeframe analysis, we're taking our FVG trading techniques to a more advanced level, giving us a better edge in the markets. This example really highlights an effective bullish entry strategy. What we're focusing on here is how to analyze a bullish setup using the fair value gap, or FVG, concept. By understanding how FVGs form and where they appear, we can identify prime opportunities for entries in a bullish trend. Now let's look at this practical trading example involving XAUUSD. Here, you can see how the setup unfolds in real market conditions. The key is recognizing the FVG and understanding its significance. It often acts as a magnet for price to move back and fill that gap, giving us a clear entry point. This approach aligns perfectly with our overall theme of disciplined, technical-based trading. It emphasizes patience and precise analysis to improve our chances of success. Remember, mastering these setups can really enhance our trading decisions and help us capitalize on market movements more confidently. When it comes to entering trades, one of the biggest pitfalls is doing so without proper structural confirmation. This increases our risk significantly because we might be acting on signals that aren't reliable. Always look for confirmation from price action itself. That way, we can be more confident that the FVG signals are valid before we commit to a trade. Another common mistake is neglecting the liquidity context. Understanding where the liquidity lies is essential because it helps us see the bigger picture and identify real opportunities. Missing this step can lead us to overlook potential trades or, worse, jump into bad ones because we don't have the full landscape. Finally, it's crucial not to trade blindly. Entering every FVG that appears without analyzing the broader context or confirming structural signals can quickly lead to losses. We need to be disciplined and thorough, confirm the signals, understand the market structure, and only then execute. Recognizing these pitfalls helps us avoid costly mistakes and improves our chances of success in FVG trading.